Okay, so in this video I'm going to talk about bids and offers. So if you take a look at this chart, this is a chart of euro-dollar as a function of time, and should be reasonably familiar. And this is the way we're generally used to seeing prices of currencies, and it's the same when you talk about a currency being reported on the news, for example, a currency pair, you'll see it, euro-dollar has gone up 1% or whatever. However, in reality, the market deals with what's called two-way prices rather than just a single price. So what was displayed on the graph before was the mid price, and that is the average between what's called the bid and the offer prices. So for example, if you're going to trade, you'll see something like the following, where you have a two-way price. You have a sell price and a buy price for a certain currency pair. So let's consider euro-dollar. And let's say the bid price is 1.3, and this is the price on the left hand side. And what this means is that you can sell euro-dollar at 1.3, i.e. you can sell €1 and receive $1.3. And like I said, this is always quoted on the left hand side of a two-way price. Now if you look at the offer price, so say in this example the offer is 130.02, and what this means is that you can buy euro-dollar for 130.02. So you can buy €1 for $1.30 and 2/100ths of a cent. And this is on the right hand side of the price. So you notice this is not the same as the bid. There's a very small difference. And so the price we're talking about at the start of this video is the mid price, which is the average between these two prices. The average between the price you can sell at and the price you can buy at. And this is what news outlets and charts will report. But in reality, you cannot trade at this price. You can either sell at 1.3 or you can buy at 1.3002. So the difference between the buy price and the sell price is called the spread. So in this example, it's 0.02 cents per USD. Okay, so say for example you were to buy €100 and then sell it immediately. In that case, you would lose 2 cents on that trade just by buying and selling the currency. That's without the market moving, and that's what's called crossing the spread. And the spread, or the width of the spread, is a proxy for liquidity. So highly liquid currencies have quite a narrow spread, such as this example here, and if the difference between the buy and the sell price is very wide, you generally say that currencies are liquid. It's not just the actual spread, it's to do with the volume on either side, which we'll come to in a bit. But this is a good way to sort of quantify the liquidity in a particular currency pair. So if you're presented with a price like this, this price in euro-dollar, you cannot buy or sell an infinite amount of money at these prices. There's a finite amount. So generally when you trade, there will be a volume listed on each side of the price. So in this example, let's say there is 5 million euros you can sell at 1.3, and there's 1 million euros you can buy at 1.3002. So for example, if you were to sell 5 million euros at 1.3000, that means you have to then go to a lower price to sell some more, because you've basically depleted the whole of that bid. So in that case, you'd have gone down to the next price. Let's say, for example, it's 1.2999, and let's say there's 6 million left. So you'd have to sell now at a lower price. So you can continue to, if you continue to sell, you continue to push the price lower. So when it comes to the volume, there's not just the volume that's listed on the bid and the offer. There's also all these bids and offers behind. So in our example, we have a bid of 1.3000 and an offer of 1.3002, but there will be bids behind that. So there'll be someone, for example, who is willing to sell at 1.3005, but that's not accessible because the market will always display the best price available. Similarly, there'll be someone who wants to buy lower down, 1.2985, for example. And this is just a plot of, this is made up of course, but it's a plot of the volume that you can possibly expect as a function of price. So generally, as you go away from where the mid is, you'll find the volume tends to be a little bit larger, because what happens in the market is people will place bids and offers, and they will sometimes leave them quite far away to say they want to put what's called a take profit. And now there'll be a video on that reasonably soon. At a high level, then that will just be left in the system, and sometimes you can set these bids to expire, or these offers to expire, or sometimes you don't. So generally you'll accumulate quite a large number of these positions away from the mid. So when it comes to trading, and if you have access to this information, it's very useful actually, because it's not just the mid price which tells you about currency. You can tell a lot from this sort of figure. You can tell, even if say the mid is 1.3001, as it is in our example, you could find, for example, on one side there are a lot less offers. The volume on the offer side is a lot lower than on the bid side, which sort of gives you the impression maybe it's going to go up. A lot less people willing to sell it than are buying it, even though the price is, for example, could be reasonably static. Okay, so say for example there's a wide price now. For in euro dollar, this would be considered quite a wide price. So say you want to buy some euro dollar, but you're not willing to pay 130.30. What you could do is place a bid. So you'll say to the market, I'm willing to buy at 1.3000, but not 1.3030. If you do that, your bid will be entered to the system and the price will go up, because you're the bid now at 1.3000, and someone else who comes along can look at the price and say, I can sell now at 1.3000. So the mid's moved up and we are now the bid. And you do exactly the same thing if you were to sell. So let's say we have the same situation and we want to sell euro dollar, but we're not prepared to sell at 129.70. We can place an offer in the middle, 130. And what we've done now, we're now the offer. So we're what would be the buy price for someone else who looks at the screen, and we've moved the price down. So the mid's now gone down from 1.3000 to 1.2985, and we are the offer. So what this means is that you can, this sort of gives you a bit of an illustration of how the mechanics of the market work, and also how you can change prices by buying and selling. So if you buy a lot of a currency or sell a lot of a currency, then you'll be pushing the price up and down. This is the whole basis of the supply and demand way the market operates, and it's similar when you actually place bids and offers as well. If you place a bid that's higher than the current bid, you're going to push the mid up, so the price is going to go up, and that's the way the market works.